Money Master the Game, a book written by Tony Robbins that shows how to gain control over personal finances. People who became wealthy made mistakes, learned from them and made adjustments to get through markets in various economic conditions, which required discipline and knowledge. On the other hand, the concept of retiring is relatively new. In a few decades we went from a life expectancy of 60 years to 80 or even 90, which implies that one can live more than 20 years after retirement. But most people don't have savings for that long. Many people are intimidated by investments and finances, and that fear can keep them from achieving financial security. In fact, investment decisions have an emotional component that is crucial to take into account. In the book, Tony proposes us to follow 7 principles. The first is to take control of money by saving consistently. Compound interest can work for us and is one of the most powerful tools in finance. It involves continuously saving, investing and reinvesting earnings. Those who start younger benefit more from it, regardless of their average income. The power of compound interest is higher. Saving is the first step to financial freedom, and what we save today can pay off over a lifetime. Automatically setting aside 10 to 15% of your monthly salary is a good starting point. And once a critical mass is reached, the interest will produce a return that can be used for years. The second principle is to know the rules. We must learn about investment myths, such as that brokers work for us and their commissions are insignificant. There's nothing further from the truth. Instead, they earn when we move money, whether we win it or lose it. If we compare commissions of 1, 2, and 3% over long periods of time, the difference in impact is dramatic. In fact, it doesn't matter if the market goes down, up, or flat. The commissions are paid the same. You have to be careful with retirement or pension fund managers, and it is also a good idea to have a fiduciary advisor who will really protect your interests. The third principle is to know the price of your dreams. We must define clear and exact objectives. It is very important if we really desire to achieve them. Most people are not clear about exactly how much money they need to be able to retire. The more clarity we have about our financial goals, the easier it will be to achieve them. That is why we must calculate future spending costs based on the standard of living we want to have and how much we can earn today. To achieve financial freedom, we must save as much as possible, get the best returns on investments, cut unnecessary expenses, and end debts and credits. The fourth principle is to practice risk management and asset allocation. All investments go up and down. The market moves in cycles, and if you do not adjust your portfolio, you can lose your gains. To diversify, you can invest in different industries and have assets whose cycles do not correlate. There are assets that are safer but with lower returns, and others that are riskier but with greater potential. Each instrument offers different guarantees and has different inherent risk that can be reduced with derivative strategies and more advanced techniques. Investors typically divide their assets among stocks, bonds, commodities, real estate, and currencies based on their age, needs, and risk tolerance. The fifth principle is to trim the downside and expand the upside. Above all, avoid losing money by managing risk and minimize downside exposure. Remember that a 50% loss in an asset requires a subsequent 100% gain to return to the original value. So we must know when to limit losses and when to take profits. Timing is also critical, since it is not the same if a recession occurs at the beginning of the savings period than at the time of retirement, etc. In addition, it is important to consider retirement insurance and financial products that offer a monthly income after a certain point in time. The sixth principle is to seek advice from experts. The best investors usually agree on their advice. Professionals wait for the right time to buy in order to achieve the best risk/reward asymmetry. And they know how to look for small investments that produce big returns. It is key to learn to make decisions with limited information. You can never know everything, but you still need to decide without having absolute knowledge but correctly assessing the risks. Crises can always occur, such as in 2008, where the recession affected almost every entire portfolio. But the more prepared you are for it, the less you will suffer. The seventh principle is to share the wealth. We must focus on our goals, take empowering actions, recognize and break negative patterns, learn new skills, and use free time to pursue personal interests. With time and effort, well-being and abundance can be achieved. But money by itself doesn't make people happier. It only empowers what one carries inside. We must live a balanced and healthy life, creating solid relationships and meeting our needs. The point of getting rich is to create a better quality of life for oneself and others, including helping causes we care about. In order to have a meaningful life, the greatest secret is to find ways to add value to the lives of others. And that's all for today. I hope you liked the video. If you did, please leave a like and subscribe to continue watching more videos like this. See you next week, and remember, smart work is the key to success.